Right. Welcome everybody to Live Valuation. I'm Midas and today we're going to be taking a look at ticker HBI, Hanesbrands. It's the first valuation of the year 2023. Pretty excited to get this year rolling overall. And I would say before the video gets started, one thing you could do for me is, as weird as this sounds, is to actually go straight from this live stream or this video if you're watching it after the fact, and actually just go watch my new video that I released yesterday, which is my final quarter update for 2022, my overall update of the returns of capital markets for 2022, as well as my own portfolio and my positioning of the portfolio for this new year. So number one thing you could actually do for me is actually just go watch that video. Of course, give this stream a like before you do so, and then like that video as well when you're there. Subscribe to the channel if you're not already, and then maybe come right back if you could. And as well as we typically do, there's also the link in the Discord below. That'd be another thing to join, is to join our Discord. The link you can find in the description below or the pinned comment chat below. It's a great place to be part of our daily discussions of what's going on in the markets and how we're positioning ourselves. So go check that out. Check the video out. Give us a like, all of the above. So before we get into Hanesbrands here today, as we typically do, we talk a little bit about what I did this week in the market and the overall watch list as we have here. As I typically do, I buy things on Mondays or Tuesdays if that's the first day of the week of the markets. So I did buy a little bit more Smith & Wesson and some more Interfor, as well as some F&G annuities, which I've been recently buying. So those are the companies I bought a little bit of this week, as well as I was repositioning a little bit of my views on all of my other positions and kind of rethinking pretty much everything in my portfolio, trying to get ready for this new year. And thinking over the things that went well last year and the things that didn't go so well. And for example, my value score that I've been relying on for allocating all the positions in my portfolio, I've definitely been doing a lot of rethinking about how I calculate that. I haven't actually made any changes yet, but I will be doing that at some point. So what we also typically talk at the start of our streams a little bit about economic data, as it has come out a bit. And there hasn't really been much economic data that's come out yet so far, or even really over the last couple of days. But there is going to be a lot of economic data that's expected to be coming out this week in just kind of general. There was some construction spending that came out today, but in particular, I'm excited to hear about the JOLTS report, the jobs report that comes out tomorrow, as well as the FOMC minutes that will be released, as well as we'll get some ADP employment data after that. And then we're also going to be getting CPI data within a week after that. Related, of course, to the CPI information is also the CPI inflation projections that I've been doing a little bit over the last couple months. If you've been paying attention to streams, you may have noticed this. I've been making I made a statistical spreadsheet where I can input a bunch of price data to make a prediction on what I think the CPI report is going to be, and I've been comparing that to the consensus of other economists and seeing whether or not my predictions are better than the economists. For the last 2 months, they've actually have been slightly better than the economists' predictions, not necessarily by a wide margin per se. It's not like they're necessarily that far off, but it's just something I've been trying to do to see whether or not I can get an idea of where that number is going to be heading and whether I think the market's going to react likely to that. As it currently stands, my current prediction for this next month, the December report, is 10 basis points for the monthly month-over-month movement. And as it turns out, the consensus number as it currently is shown on Trading Economics is also 10 basis points. So it seems like the economists are in agreement with me. And just so it's clear, I make my prediction on the first of the month, so right after the month ends, and this consensus number doesn't really show up until usually a couple days later. In fact, this was the first day I saw it on this website. So I do make my prediction before I see this consensus number, in case anybody was wondering about that. So other interesting projects that I've been kind of working on in the backdrop of the channel. This was discussed a little bit in the Discord, so it's another reason to join the Discord, is to kind of hear about how we're doing things about that. Some viewers to the channel had kind of asked me to maybe make some model portfolios based around the watch list that we usually track, that has all of the other valuations that I've done for the channel, but are not companies that I'm personally invested in, because obviously I'm only invested in a handful of the companies, even though I have like 80 or so valuations here. So some people were asking whether or not I would be interested in making model portfolios out of the rest of the valuations that I've done, And I did give some thought about how I was going to be doing that. And so I did implement that here at the start of this year, using basically the year-end data as my starting point to kind of judge the returns for my model portfolios. So what I did for the model portfolios is I made actually 4 of them. One of them is equal weight of all of the valuations as I had them at the end of the year. The equal weight purpose of it is to make it so that it's kind of like my standard that I can measure against, because there's obviously going to be a lot of selection bias in the companies that I even choose to make valuations of. I make company valuations based off of companies sometimes that I think are undervalued, but sometimes I just am interested in the company. It has nothing to do with value. It can be a wide range of reasons why I end up doing a valuation of a company. And so I did want to see what an equal weight of the overall amount of valuations would look like to kind of take out that bias, so to speak, and see what it would just be like if I had just selected these companies equally. But then the 3 model portfolios that are more an actual judgment of my actual analysis is a valuated portfolio, which basically means I'm taking all of the companies and I'm listing them by how much I find them to be overvalued or undervalued, just flat out to fair value. And then I'm not including companies that I find to be undervalued. So it only includes a selection of the companies that are there. Then I made another one with total return weighted, which is weighted by the total COGR, which is not just how overvalued they are, but the total expected annual returns that I find them to be expected to have for the next 5 years, which gets a different selection of companies. And then I also only included companies whose total return was higher than the S&P 500 discount rate that I'm currently using at the time, which is about 9.5% or something like that. That isn't to say that the S&P 500 I expect actually to do 9.5%, but the point is it assumes that you're selecting companies based off of the alternative being the S&P 500, and you have to select it today. So that's kind of the logic behind it. But as you can see, it's a slightly different selection of companies there. Then the third model portfolio that I chose to make is actually a long short portfolio, where I do again include all of the companies in the entire selection. However, some of them, the ones that I find to be over or undervalued, the ones that are overvalued, I actually short proportionately, as you can see marked red here. And as it ends up being, it's not a perfect 50-50 long short. It ends up being about 5% tilted to the long. So being like 52.5 to 47.5 or something like that is what the actual tilt on that ends up being. So as I said, I did list the 2022 end of year price, and I'll be keeping track of the dividends probably on like maybe a quarterly basis or something like that. I plan to make a side video for this, and then I'll probably make videos each quarter, keeping track of it, or keeping track of it with the rest of my returns. And then I'm keeping track of the returns of each of these model portfolios and comparing it to the return of the total S&P 500 as well. As you see, Google's being a little bit weird with its import data at the moment, partially because I have so many spreadsheets open, so you can't see it super well. Oh, I decided to clear it up. But as we can see right here, for example, the S&P 500 is actually down about 0.4% today, but all of these model portfolios are up. But you can see the equal weighted one is up 0.5%, which means that 0.5% is what you would sort of expect all of the rest of them to do if all of my analysis was random. You would kind of expect the other 3 to at least do 0.5%. So you could subtract 0.5% out from the expected return there, and then that gets you kind of the alpha to the selection bias, so to speak. Anyway, there is a link to this model portfolio that can be found in the Discord, both in the portfolio channel, as well as it can be found in the actual Google Drive link, where I have a Google Drive with various other spreadsheets that can be accessed for members of the Discord. So I would suggest going and checking that out if you're interested in that. So other things that I also was working on over the kind of the holidays week is a lot of information related to my DCF template that I've talked about a lot over the last year. It's a pretty complex template that I've been putting together, both for analysis of financial statements, as well as putting together an actual discounted cash flow valuation. In fact, as it turns out, it ended up so complicated that I had to split them into 2 separate spreadsheets, which, as you can see right here, this is kind of the financial statement spreadsheet where it does analysis of all the financial statements. And then that spreadsheet links into the DCF template. And I separated them so I can make sure that they operated smoothly and weren't being entirely clunky. But it is coming relatively to a close. I am not sure how much longer it's going to take me to complete it. I was really hoping to complete this project by the end of the year, And I was really hoping to get it much done earlier in the year, but by halfway through the year, I was kind of like, well, maybe by the end of the year, I'll finish it. And obviously here we are at the start of the next year, and I haven't fully finished it yet. But I would say that the project is definitely coming along. The idea is to be able to have separate probability pathways assigned to revenue growth, as well as margin assumptions, as well as capital investment assumptions, as well as a weighted average cost of capital and terminal growth assumptions, to end up with a pretty complex distribution of probabilities weighted across 243 different separate valuations, unique valuations that are then weighted across a 1,000 valuation distribution, which is what you see right here. This is basically a sample of 1,000 valuations weighted across 243 different pathways that allow for 27 different probability features essentially to the valuation. Very, very complex tool, effectively speaking, but this is basically going to allow my valuations to become much more sophisticated. And I've also been working to make the spreadsheet a lot more user-friendly and actually easier to read than the kind of old clunky spreadsheet that I've been using a lot for my valuations, and the one I'm actually going to be using here today. So anyway, that took a little few minutes to get through all the talk about all that stuff right there, but it was kind of all the little side projects that I've been working in the background that I definitely kind of wanted to talk about, partially because I'm going to be using those tools at various points on the channel here for my valuations, and also because I want them to be of interest because I plan to make videos related to them. So getting into the Hanes valuation now, starting with some company information as we typically do. The company was founded in 1901 here in the United States. It is on the New York Stock Exchange. I have its main websites kind of listed here. Its current CEO is Stefan Bratspies, was elected to CEO and made chairman of the board in 2020. And he joined also in 2020. He was part of the merchandising department of Walmart prior to that. Obviously, Hanesbrands is part of the apparel industry. One of the things that was really interesting me about the company and attracted me to want to do a valuation of them was just the idea of them being a super hardcore necessity. I mean, who doesn't need underwear, obviously? So I was like, wow, that's an interesting industry. It's just obviously not going to be a high growth industry, so it comes down to really whether or not you can get it at a really good valuation. Did also pay a pretty hefty dividend, so that was pretty interesting. Though obviously it being a very, very high yield meant that there was probably some warning signs, and that's definitely what we found here today. We'll be getting into that, but there is lots of risks to be had here. But it goes just beyond them being a needs brand, but they're also a very major brand. What with their kind of umbrella of their subsidiaries, it's not just the Hanes brand, but there's Champion, Maidenform, Just My Size, Ralph Lauren, Playtex. There's a few others I'm forgetting, but there's like a whole range of underwear, bra, athletic fits, just a whole bunch of under apparel products across the board. And they're I think it was something like 65% to 70% of American households have a Hanes product in them, and they also have relatively high penetration up into like 40% or something like that in other English speaking markets such as the UK and in particular Australia, which I mean, I believe it was about 30% of their incomes come from outside the United States. So I was very interested in just kind of looking at this this particular brand because it's a major brand, but it did come down, like I said, to a major value because of that high penetration is kind of a double-edged sword. On one hand, it means that everybody knows them, everybody relies on them. In a pinch, they're considered the cheap, reliable product in a lot of ways, but at the same time, that means that they aren't going to have a lot of avenues for growth, as we kind of talked about. Top customers, Walmart and Target. I think Walmart was the only customer of theirs that was over 10% of their net revenues, but they did list Target as another major customer of theirs. And then other customers is pretty much all mid-size clothing merchandising stores. They listed them stores being like Kohl's or Macy's and even Dick's Sporting Goods. Top competitors, they did list actually a pretty wide variety of competitors, and being in the apparel manufacturing, there is going to be a wide variety of competitors for them. But the biggest competitors are Fruit of the Loom, which I listed Berkshire Hathaway there because Fruit of the Loom is in fact a Berkshire subsidiary, but that is their biggest competitor, is Fruit of the Loom. But then there's the like of Victoria's Secret and even other brands such as Nike and Puma. Like I said, lots of athletic wear as well. I didn't list any major suppliers. I didn't find that to be a super relevant piece of information for them. The next report is expected to be on the 3rd of February, so coming relatively close, and that's actually going to be their 4th quarter report. I definitely have for the last 2 to 3 months or so had a huge bias towards just going for companies that have only just released their 10Ks, partially just because I do like to have all the information be as up fresh as possible. So that was kind of what I have been doing. So this is, I think, the first company in a while that I just did it off of a quarterly data, but that was their 3rd quarter that they did recently. So it should be their 4th quarter and final annual report that comes in on the 3rd. They do have some revenue guidance in their 3rd quarter report, saying that they're expecting the total 2022 revenues for them to be at a midpoint of 6.19 billion. That's net of a certain amount of FX. They said, I think it was about like 500 million or something like that worth of total net FX or something hit they're expecting there. And then other guys, they're expecting 527 of operating profit, also net of a certain amount of FX. I can't remember the exact amount there. It was like less than 100 or something like that, 100 million. Analysts, according to the revenue, according to analysts, is 6.18 billion, according to 11 analysts, and 6.19 billion according to 11 analysts for the next year. Also, I did miss the other piece of guidance that the company had given was a midpoint of diluted EPS 86 cents per share, which we'll definitely be relying on for our short-term margin assumptions, as we typically often do. And then analysts also gave similarly an EPS assumption of 97 cents according to 11 analysts for this year, and then 99 cents according to analysts for next year. 60 cents for the trailing 12-month dividend. 60 cents is expected for the forward dividend. They haven't actually raised their dividend for the last couple of years, which is a good thing. We'll get into that in a little bit. But that does annualize up to almost 9% yield on the current share price, which is kind of what I was talking about. A pretty hefty dividend, which on one hand is very attractive. It makes me very interested in the company, but at the same time, it's like, what's the warning signs there? Why did it get that high? There is technically a small amount of shares authorized for buyback, but very, very tiny amount. It's literally almost zero. They did very, very tiny amounts of buybacks this entire year, which is a bit funny considering they did significant more amount of buybacks in the previous years before that. We'll get into that. Again, warning signs and kind of problems that we saw on the analysis here. There is a relatively small amount of insider holdings, less than 1%, but it did increase about 8 to 9% or so over the last 6 months. 87% of the shares outstanding is held by institutions, which you would expect with such a large, mature, developed company. Short outstanding, 16% of the outstanding amount, 18% over the float shares, which was definitely one of the things that was attracting me to it, is the high short level. I do like high short levels as I see it as a potential bottoming on the share price, considering people do have to buy them back. So it looks as a potential bottoming at some point for the share price, but it definitely looks like the shorts might be more onto something here today. Not to fully spoil what we find here, but we'll get into that. I've kind of already peppering in the hints of a lot of the little negative things that I found in the analysis here. The short ratio is up to 6, so that means that there is the shorts would need about 6 days to cover off the current volume levels. But as we're saying, that may not be a huge warning sign for them as it currently stands. 3-month average volume is under 10 million shares per day. In the last 10 days, it's actually just risen above the 10 million point. So a little bit more elevated volumes, which on one hand you could say is a worrisome sign for the shorts, but that kind of depends on which direction the volume goes, which we don't really have listed there. Getting beyond that, we're not really going to look at too much specific information from their earnings release. They didn't really have too much information kind of depicted there in a way that's super useful for that. The only thing to do with maybe to kind of like point out some more of the brands that I didn't mention before here that they list from the 10K. Part of their, for example, the innerwear segment, they have Hanes, Bali, Maidenform, Playtex, Champion, Just My Size, Bras and Things, Polo, Ralph Lauren, Activewear, Champion, Hanes, Alternative, Gear for Sports, Comfort Wash, Just My Size, Hanes, BFT, International, pretty much all of those in different amounts, and then a couple of slightly different ones. So yeah, pretty much, wide range of brands. They don't really have a great earnings presentation to look at necessarily. Before we do get into a lot of the specifics for the segmentation and valuation, we will come over to our data industry tool, so I can kind of point out some of the data on here that we're going to be relying on. I have the apparel industry set up over here, but I did also pull open the retail special lines industry, which isn't really their industry, but it's somewhat related to like how their products are going to be sold. So I do kind of like to think about some ways in which it's related. You could have also pulled up in just kind of general retail. It would have been probably just as relevant, but either way, we're not really looking at that much. The apparel The unadjusted unlevered beta as it currently stands is 0.93, so that is going to be the beta before adjusting for leverage that I'm going to be using for them. Gross margins for this industry is more recently been tailoring up into the 50s. More traditionally for the last 5 years on average, it's been pretty much about 50% or so. Coming down, we can see that the adjusted net margins for on average for the last 8 years in apparel has been about 5%. It's worth noting and paying attention that the adjusting operating margins is about 11%. So it's kind of worth paying attention to that because there's going to be quite a lot of interest and payments being done in such a mature industry. So 11% down to 5% means 6% as a percent of sales is pretty typical, not necessarily for interest, but for all of the interest, taxes, and technically any other non outside of taxing income that is put there. So don't forget about the tax part. That's going to be part of it as well. Sales capital ratio for the last 3 years on average 1.62. That's $1.62 of revenue for each dollar capital invested in the business. Overall, and interestingly enough, I'm a bit surprised to see the returns on invested capital are pretty strong for the industry. Not so great for Hanes, but we'll get into that. But then also, I kind of wanted to point out there's the debt to equity ratio, which is going to be kind of important for Hanes because debt is a huge part of the story, and it's related to pretty much all of the kind of worrying signs I've kind of mentioned so far. Debt to equity ratio is kind of staying in this kind of 30s, maybe up to 40s, at kind of a higher end of something range for this industry. Hanes is well over 100%, so that's going to be part of the story. It's very much a debt valuation play, and well, it's not really a play at all in my book, but anyway, we'll get to that. So coming over to the actual valuation. Coming down here, looking at the segmentation, as I was just saying, we're counting as part of the apparel industry. So adjusted unlevered beta of 0.93. I have the sales capital ratio and the adjusted net margins for the industry listed there as well. They have 70% of their sales in the United States and 30% international. So we end up with an equity risk premium for them after adjusting for the current date of 6.12, which I multiply by the levered beta, which has been adjusted by the debt to equity ratio, which is currently at about 180%. That's based off of the about $4.3 billion of debt that they have currently, including lease liabilities, a pretty significant amount of debt. That does bring their overall cost of equity up to about 18%. 18% cost of equity, which is pretty hefty. Their cost of capital is, however, only 8.72%, which is pretty decent overall. And that's because obviously they have a huge amount of debt. So even though what that does is that the huge amount of debt raises their cost of equity, it makes the risk exist for the equity, but the overall cost of capital remains relatively manageable because of the huge proportion of the actual debt that ends up there. So they can take projects that are still within a reasonable range, but however, the risk is essentially being shelved onto the equity person. That's kind of why we use this leveraging methodology for our beta calculation, just in case anybody was ever wondering. I'm not sure I've ever actually really gotten into too much of the specifics of the theory of that. No, I think I have before when I was going through my spreadsheet calculation for that, but I definitely don't talk about it a lot because it's kind of an entire hour's worth of a discussion itself. Anyway, so I digress. Coming over to take a look at the financial history for the last 10 years, going from 2014 up through, like I said, the trailing 12 months that we've last had, which technically has a 1 quarter overlap with 2022, but that's kind of what we have listed here. So taking a look at their overall, you can see that for the first 5-year period, they had a pretty consistent amount of growth, growing at a CAGR of about 8%. It was pretty consistent through here. Obviously, it was kind of a 15% in 2015, and then 5% in 2019, and then kind of more in the middle throughout the range of it, but pretty solid growth up to that point. And then obviously in 2020 there was almost 6% drop in revenues. 2021 down almost 5%. A little bit of rebound in this kind of forward here. I just realized I never actually changed this up here. I knew I said something wrong there. This is actually supposed to be fiscal 2021, not fiscal 2022. Oh, whoops. I just realized that, like, I was like, wait a minute, 2014 doesn't sound right. Why did I say 2014? That doesn't actually, my bad. Always forget to change that bar up there because that's just kind of like listed up there. Anyway, I was like, that doesn't sound right. They had a revenue decline before they got to 2019. I knew what I was saying didn't sound like what I was researching before. But anyway, yeah. So anyway, they grew up through 2018, up to 5% up through 2018, and then they had a little bit of revenue decline in 2019, which I thought was partially a warning sign because they were having revenue decline before 2020. Obviously, lots of companies had revenue declines in 2020, so a lot of companies, people look at that and be like, well, maybe we can kind of ignore that. For some industries, you don't want to ignore that. For some industries, you can be like, well, that was just a blip in the history. But obviously they had a little bit of a decline in 2020, which shows that maybe they had already kind of accelerated through some of the revenue growth previously. And they also had done some acquisitions, which we'll get to when we get down to the cash flow statement. But a little bit of decline in 2019, a further decline in 2020, a bounce back in 2021. And then over the last 12 months, it's come back down a little bit from that level as well. So 6.5 billion is where they're currently at in the last trailing 12 months. And they reached that back in 2018, midway through the year. So they haven't really had any growth up through that point, showing that this maybe is kind of the point where they had saturated. A lot of that growth had come through internationally for those last few years as well. Anyway, so moving past the revenues though, we can see the gross margins. For the first 5-year period, they had gross margins of about 37, almost 38%. And then for the next 5 years, it's been up over the 38% for the majority of the time, although there has been a little bit of some variability in it. And then it's ended actually below 37%. But it is worth noting that in all cases, that's still pretty solidly above the like 33 to 34% that we are seeing for their overall industry. So you could say that they have pretty solid gross margins and pretty solid overall cost efficiencies on that scale. And that could come from the overall scale that the business has gone, the amount of household penetration that they've managed to have. If you take a look at their operating margins, for example, we were talking about the 8-year average operating margin was what was a 10, 11%, 11, 12%, I think it was. And they have 13 to 14%. So you can see that's pretty solid for that same period of time. Though it has been coming down, you can also pretty consistently over that same time, coming down to 14%, down to 13%, down to 12%, now down to 11.5%. So while they were pretty solidly above that level, you could say that that's starting to catch up with them. And then that's still above the point where they're paying for their debt, which, as I was saying, that's where the real problem for them starts to creep in. If you come down to take a look at their operating margins for, the net income margins for the last 8 years, that ends up being about 4.5%, which we were saying that it was about 5% for their industry. So they are below their industry for that level. If you do take a look at the net income margins prior to COVID, just to see if maybe it was that has a large factor. They did have net income margins of 7.5% prior to COVID. So you could say that definitely has maybe had a factor with the negative margins they had in 2020 and pretty weak margins, almost non-existent really in 2021. They did have a pretty solid bounce back over the last trailing 12 months, even though they've had that decline in revenue over the last trailing 12 months. So you could say their costs were catching back up with the revenues, so to speak, a little bit. But whether or not that's going to bounce back is a definite question. I don't know about that. There's kind of some other factors to take into account with that, which is about the levels of debt that they've taken on. As we've kind of talked about, they've had lots of debt pretty consistently through this, but you can also see the cost of debt, 3-year average rolling, has consistently been moving downward over this 10-year period, which is what you would expect for a company that's been continually rolling its debt over in a lower interest rate environment. But interest rates are starting to spike up, and that hasn't really started to hit them yet. In fact, their interest rates expense as a percentage of the debt has decreased over the last trailing 12 months, not increased. So what I would argue is that this has a pretty substantial chance of going from 3.75% to maybe up to 5%, maybe up to 6% within the next 2 years or something like that, depending on their overall rollover, which they had a maturity of about 4 years or something like that. So you could start to see some significant rollover within a couple of years is kind of the point I'm trying to make. And then that doesn't take into account what is that cost of debt as a percentage of their sales, which I actually did create a line for that down here. You can see that the cost of debt as a percentage of sales has actually remained pretty consistent over the entire 10-year time frame, being on average about 2.4%, and it's currently been about 2.2%. So we've actually had higher levels of the debt interest as a percentage of sales back in 2017, 2018, which is when the interest rates were increasing previously, and we're currently up at higher levels than that already. So it was already getting close to 3% at this point, and this is still at 2%. So the idea that it, as a percentage of sales becomes 3 or 4%, I think is pretty reasonable, which that increase from 2 to 3 to 4% would be a direct decrease of the net margin. So if this goes from 2% up to 4%, then this goes from 5% down to 3% is kind of the point I'm making. So we kind of got a little bit ahead of ourselves on explaining like how I'm thinking about their future margins right here when we haven't even finished their financial history, but considering it was related to talking about those details right there, I kind of wanted to just talk about that right now because it's pretty relevant for the overall valuation that we're doing. So taking a look at their cash flows, the adjusted net capex, which it combines their capital expenditures, any amounts of money spent on acquisitions, the amounts spent on working capital, which includes investments in inventories and things like that, as well as then netting out the depreciation and amortization, and boils all that into one number so we can get an idea of just how much of their earnings that they're actually plowing back into their business on an annual basis. You can see for the first 5-year period, they averaged about 377 million per year that was being reinvested back in their business. And it's worth noting that that's comparing to the annual earnings that they were having over that same time frame of 394. So basically all of their earnings were being reinvested back in their business during that time frame. And then over the next 5-year period, we've averaged 45 million that's been reinvested back in their business versus the amount that they've had of earnings of 284 million. So it kind of depends on how you're looking at that. And then that that is basically free cash flow would be what's left over after that, and then free cash flow to equity would be adding on the issuance of debt after that, which issuance of debt is something that we pay attention to because we're paying attention to free cash flows to equity. And you can see that for over the entire 10-year time frame, they've on average been issuing about $191 million in debt per year. Again, we've had pretty significant amounts of debt, and they've done a little bit of pay down in the last few years or so. They did some pay down in 2019 and some pay down in 2020, but then they've kind of bounced back a little bit in 2020, and then a little bit more bounce back over the trailing 12 months. So whether or not they're going to actually successfully start paying down the debt is a real question. So that's going to be important to take into account when we're talking about our projections for the debt to equity ratio. Because if you have a high debt to equity ratio, it's easy to think, oh, well, all I need to do is trim this number down. If all they have to do is fix their debt to equity ratio, that's all the risk. If they just pay down their debt, we can increase the valuation so much. And it's like, that's easy to say. Whether or not they're going to do it is a big question. And that's important to understand because let's look at the cash flows that they've actually been paying out to their shareholders. Now, the free cash flow to equity, which is the amount of money that they can pay out to their shareholders, and that's net of the amount of debt that they've issued. So it's saying, okay, including the money that you're issuing for debt, we're including that money. The amount they had for the first 5 years was 462 million that they could have paid out, and the amount that they did pay out during that time frame was 413. So they didn't overpay their shareholders for the first 5-year period, and then for the next 5-year period, they had 178 million that they could have paid out, and the amount they did pay out was 258 million. So they did overpay their shareholders for the last 5 years. Overall, for the last 10 years, they could have paid out 320 million, and the amount they did pay out was 335 million. So over the last 5 years and over the last 10 years on a total cumulative basis, they've been overpaying their shareholders. And as we were just saying, over a pretty consistent 10-year time frame, they pretty much regularly have to do significant amounts of reinvestment of their earnings back into their business, and they're overpaying their shareholders, and they've been issuing debt, which basically means that if they want to continue doing both of those activities, they would have to continue issuing more debt. If they want to not issue more debt, they would have to choose to not do one of those activities and possibly even not do a significant portion of both of them. So that's the problem here, is that they either have to stop doing high returns, or they're gonna increase the risk even more, or they're going to have to stop reinvesting in their business. And they've basically telegraphed that that's not what they're going to be doing. They do have also some guidance for the capital expenditures that they listed. I didn't actually put that in my listing of the information here because I'm not making projections based off of it, but they do talk about doing 300-400 million worth of capex, or I think it was actually more like 250 million. My bad. Remembering the wrong number there. It was like 250 million, I think they were expecting for the next year in capital expenditures in total. So still pretty significant amounts of capital expenditures. And if you net that out of there and then include any amount of inventories or receivables investment as well, then suddenly you're reinvesting the vast majority of your earnings and don't have any room for dividends to be paid out, which is what they've been doing regardless. And I did mention that before, that they haven't increased their dividends since 2017, and that's why I said it was a good thing. It's because, well, frankly, they're already overpaying their shareholders as is. They quadrupled their dividends over a 4-year period to the point of now they're overpaying. And then they've been overpaying, and they basically had been overpaying pretty much as soon as like a year or two later as they reached that point, which is pretty funny. And I mean, that's not entirely uncommon to see companies basically just raise their dividends up all the way up to the point where it's too much, and just that's like what they do. It's like, well, you could have just slowed down, but they don't. But anyway, so getting past that point, returns on invested capital, they did have pretty significant returns on invested capital for those first 5 years as well. You could easily see why they would have the high optimism they did, 14% or so on average, a little bit higher than that even. For the last 5 years, it's been less than 10%, 9.5%, 9.6%. over the entire 10-year time frame, that ends up being about 12%. So still pretty solid. But again, that's looking to the past. That's not looking to the future. What we have here is a consistent downward trend of the returns of invested capital. And it's partially because they're just piling on the debt, which is more and more capital, but they're not really getting that much more returns out of it. Returns on equity, that, however, has had pretty consistently solid numbers as long as we're counting the good years. For the first 5 years, they had average returns on equity of 38%. And for the last 5 years, including the trailing 12 months, it's been about 12%. So it's still a huge decrease, but that's partially because we have this huge negative year here in 2020. If we discount that from the sample, maybe we'll even throw on more years, so it's still a 5-year sample, even though it creates a little bit of overlap. That would create an average of 48%, which would be higher than the 38% that we had here, which included that same year. So if we discount 2020, which was definitely a freak year in some ways, though it would also be reasonable to include it depending on what you're thinking about, then you could say the return on equity has actually increased, but it's increased at the expense of the returns in invested capital. And it's like, that's great, but the returns on invested capital can only go down so much to increase the returns on equity, because once the returns on invested capital go below your cost of capital, at that point, you're just destroying your equity value. You're not going to be increasing it anymore. So it looks more like financial engineering more than anything. Pile on the debt, pile on the leverage, increase the returns on equity, but at the cost of our returns on capital. So coming down here to the balance sheet, we can see pretty consistent growth of the balance sheet over time. The total cash on hand, they had 115 at the start of the 10-year time frame, averaging about 300 million on hand for the first 5 years, and then they averaged about 490 million for the next 5 years, and then ending at 253 million. So there's been a pretty consistent growth of cash on hand throughout the business. However, you could argue that the current amount of cash on hand is relatively weak, which is, two things to say about that. On one hand, you want to have cash on hand because it de-risks your business, in particular if you have a lot of debt, which they do. But at the same time, you want your capital to be at work. So not having a bunch of cash on hand helps for that too. So there's two kind of ways to look at that. Considering how much risk they have, I would kind of wish that they would have more debt, more cash on hand and less debt. That is what it is. Total inventories have also grown pretty consistently. The average amount of inventories for the first 5 years were 1.6 billion. For the next 5 years, they averaged about 1.8 billion, and then they've ended here in the last trailing 12 months at 2.1 billion or so. So growth of inventories, that's pretty much the consistent meme on this channel. It's just, how about them inventories? How about them inventories? That's a little bit of high growth of inventories. I would say that the growth of inventories for the last 5 years has grown at a CAGR of 5%, which is, comparing that to the growth of their revenues for the last 5 years have been flat. Then you could say, well, what about the 5 years prior to that? There was 8% of revenue growth prior to that, and then the inventory growth in the 5 year prior to that was at 17%. So I would say that even prior to this, over any consistent period throughout the entire 10-year time frame, it's pretty much inarguable that their inventories have been growing and growing and growing, and that basically leads to lower profitability in the future. So coming down past that, we can take a look at their liabilities. The total current assets, as you can see, has gone from about 1 billion up to 2 billion over the 10-year time frame. And comparing current liabilities to the current assets, 2.2 billion up to 3.5 billion. So they have grown their overall working capital pretty consistently, but it isn't growing at necessarily a very dramatic pace. We have about the total working capital ends up about 1.2 billion back in 2013, and that only ends up at 1.5 billion here. So they have grown their overall balance sheet, but they haven't necessarily grown in a total asset sense. It's really come mostly at the expense of growth of liabilities, which is another way of saying that they've been piling on the debt. I mean, going from 1.4 billion in debt up to 3.9 billion in debt in the long-term debt, not counting the small amounts of current debt. Coming down to the shareholders' equity, we can see that their shareholders' equity went from 1.2 billion in 2013 to about 675 million in the trailing 12 months here. That does partially come with a little bit of a shakeup in the balance sheet that they had between 2016 and 2017 when they were spinning off certain assets and also acquiring a couple companies within 2017 and 2018. So there was a little bit of a shakeup and change on the overall balance sheet structure in this time frame that partially explains part of what's going on there. And then you can also see the shrink of the retained earnings, which has a very similar drop in 2017 to 2018, and then it grew up to a re-peak actually at a high level in 2019, and then it's decreased since then. So coming down past that point down to the sales capital ratio, we can see the sales capital ratio for the first 5-year period averaged about 1.51. That's $1.51 in revenue for each dollar of capital invested in the business. And then for the last 5-year period, it's been $1.43. So a decrease in the overall sales capital ratio. And then we were comparing to the industry on the last 3-year average, which is $1.46. So $1.46 is their sales capital ratio compared to their industry of $1.62. So relatively not as good capital efficiency compared to their industry in the last 3 years on average. And that is comparative to, as we kind of talked about, a relatively weak net margin compared to the industry, just barely, but relatively strong gross margins compared to their industry. So you could see how they have a pretty strong financial competitive advantage in some areas. However, they've sacrificed quite a lot of that at the expense of their net margins. So that's pretty much all the financial history we need to take a look at before we can really get into the specifics of the actual projections for the valuation that I put here. Now, I've been trying to do a lot more of like a proper breakdown of revenues by segments for industries for my valuations, and making like actual projections based off of certain sales of units or growth of certain sectors or industries, or projections based off of macro factors. I've been trying to do a little bit more of sophisticated revenue projections here on the channel for a lot of my more recent valuations, and I was planning to kind of do that for Hanesbrands, but as I was kind of putting the valuation together, I was just seeing so much negative that honestly it just completely discouraged my interest from even really wanting to put the effort to that. And to kind of belabor the point, obviously you can see I already have it at about 35% with these the current assumptions that I have in place, which are the assumptions that I planned to use primarily, which I'll go over here in a second. But I did also kind of play with the numbers a little bit and input a bunch of much better assumptions to kind of show that even if I just increase everything and make everything better for them and make the most rosiest assumptions, it really doesn't do much for them. So it didn't really feel that important for me to think, okay, well, here's how much market penetration I think they can do in the US versus how much market penetration I think they can do in Australia, and here's how much underwear I think people are going to buy next year, and here's how many bras I think people are going to buy next year after that. You know, that just seemed like a waste of time after I did this. So just to kind of belabor the point, if I just significantly increase here, hold on just a second. Just realized if I just significantly increase the expected revenue growth, and I significantly increase or significantly decrease the lowest potential margins, and I also significantly decrease the total debt load that they're going to have for their company, as well as I significantly increase the sales to capital ratio that they're or the worst case sales to capital ratio that they're going to have, as well as I completely decrease get rid of all of the interest cost risk that they have. I do all of that. I massively increase everything for them, and then we still basically just get them barely to fair value, just barely to fair value. With all of that, I basically make it a rosy picture for every single metric across the board, and it just barely gets them to fair value on an expected basis. Obviously that creates the best case scenarios as that, but I was just talking about getting the expected case up to that point. And I don't actually agree with any of those things, first of all. So like we can actually go through all of the real assumptions that I have in place here, but also keep in mind all of the negative things I was just talking about the company when I get into these things. Firstly, there's revenues. We already talked about the fact that they have huge market penetration, up over 60%. I think it was even close to 70% of US households, and it was over 50% of even other English speaking country households like Australia and places like that. Like, that's great. That means that they might not lose the revenues, but that means it's very unlikely they're going to gain more revenues. And then we already talked about the fact that they were having trouble with the revenues prior to 2020, which really doesn't give me a whole lot of strength to believe that they're going to get higher revenue growth in the future. Not to mention the revenue growth that they were getting prior to that were coming off of the backs of acquisitions that they were doing pretty consistently through 2013 up through 2018, which is the last point where they had the revenue growth, was after that point. So they stopped doing acquisitions and suddenly they stopped getting revenue growth. So it's like, okay, I don't really think that they're going to get much revenue growth then. So I do have expected revenue decline in place for them. Now, I do actually have a tilt towards better probabilities for them, but that's because most of my assumptions are relatively negative. So really, I'm just leaning towards
the less negative outcomes for what I actually expect to happen. So that's not really doing them much favor, effectively speaking, is what I mean by that. Now getting into margins, we talked about the interest cost. We talked about how their interest cost for the last 12 months is less than 4%, even though they had gotten up to almost 4.5% when in 2018, when there was the previous increase in interest rates up to 4.5%, almost to 5%, which makes me think that this 3.75% could easily become 4.75% or 5.75% with the interest rate increases that we've had over the last year, and the fact that that debt's going to have to roll over time for Hanesbrands. So I could easily see, and we talked about the same thing, the interest cost as a percentage of sales, which we saw the same thing, percentage of sales peaked close to 3% when we're currently down to close to 2%. So I could easily seeing it go to 3%, if not to maybe even close to 4%, which would mean a decrease of 1 to 2% in net margins. Now, I actually, on an expected basis, only have my net margins for them decreasing about 0.5%. Now, that's because I do reasonably see them as having a decent, strong operating control, as we saw in the gross margins and in the operating margins. However, we saw the operating margins also starting to decrease, and I think that's partially become at the increase of SG&A costs, partially because they've expanded their business internationally. So with the fact that they're probably going to be doing less of that in the future, maybe that won't affect them as much, and so I didn't decrease the net margins that much. But the point is, I definitely don't see them getting higher net margins in the future. We saw over the 10-year time frame, the average net margin they had was 5.7%. So I chose to make their net margins about 1% less than that average net margin they've had over the last 10 years. That average does include the negative from 2020, but it also includes the outliers from the years where they were getting the special tax treatments as well. So that's just a bit of a wash in my book. So that's my assumptions for the net margins. Then if I come down the sales capital ratio, I expect their sales to be coming down, as I kind of showed with my revenue projections. But even if their sales remain flat or increase slightly, I do expect them to have to roll over their debt, as we talked about, which means they're going to have to be increasing their over capital base, which means their sales capital ratio is not likely to increase. I left room for it to increase, and I like I said, I'm tilting more towards optimistic outcomes, but I do see their sales capital ratio declining a little bit right there. So I have it coming down to 1.2. You could argue that maybe the worst case scenario is a bit really worst case, but even by increasing it that much, it doesn't really hardly change a thing. In fact, I'll just go ahead and leave that as is, because I'm fine with that. That doesn't really change anything. Then coming down to the debt to equity ratio, we talked about the debt in terms of the capital and in terms of the margins, but both of the picture that was painted there was that the debt to equity ratio is, at least in nominal terms, the debt is definitely not going to decrease. So the question is the percentage as a ratio to the market cap actually going to decrease? And the answer to that is not likely if the stock is overvalued, because it means the stock is likely to go down, which means the debt to equity ratio is actually likely to go up, because the stock is going to go down. There's a reflexivity that exists between that when you have a market weight for your debt to equity ratio, which is just the methodology I choose to use, but I do think it's actually representative of the risk of the company. So the point is I don't see the debt to equity ratio increasing. It's or decreasing. It's currently at about 180%, and with the assumptions I have in place, I have it going to 193%, which, considering I have them at 35% overvalued, that's probably doing them a favor. That's probably doing them a huge favor. So whatever, that's my debt to equity ratio assumption. And then with the debt to equity ratio assumptions, we end up with a huge amount of default risk that I did already input the assumptions for there. So that's all of the assumptions that comes in place for the valuation. And like I said, it didn't really even require me to even think about too much about revenues, because doing much to the revenues doesn't really help them that much. Like, it helps them a bit, but it doesn't really help them. Not enough to make it worth it. So I definitely chose not to waste my time on that. And like I said, I already played with the numbers showing how it can change everything if you change everything together. And it's like, yeah, you can make the stock fair value under those assumptions, but that requires them to have some magic scenario where all this debt problem they have disappears, as we just talked about. And that doesn't even take into account their rising inventories, which would be another pressure on their margins, which I didn't even discuss. So the fact that I only decreased their average margin from 5.7% down to 4.7%, that's also doing them a favor. It might be better to do it closer to 4%, but whatever, 4%, we're still at this point. So with all of that, that brings me to the final valuation. Those are all the assumptions in place that I need to do for my final valuation. Before I get to that and get to doing all of that in the summary, I'll ask one more time, please give us a like. If you're liking now live or on replay, please like the stream. It is the #1 way that you can help pay me for my content that I do here. The #2 way that you can pay me is to go watch my recent video that I released for the total returns of 2022, the final return update of 2022. That would be another cool thing to do, is go watch that video, watch it all the way through, would be super appreciated, and like it would be super appreciated. And if you've done both of those things, please subscribe to the channel if you're not already. Subscribe to the channel, that way you get notifications when I go live or when I release other videos like the 2022 returns video. I'm planning some other videos that I'm going to be releasing in the near future as well, if I can get the nerve together to actually edit videos. And then if you've done all those things, also join the Discord, the link to which can be found in the description below. It's also the pinned comment in the chat. Join the Discord, that way you can be part of the discussions we have every day about activities going on in the market, our own portfolios, analysis of companies, things like that. So come be part of the discussion there. So HBI, Hanesbrands, starting to annoy me. I was like, come on Google, load the thing. Hanesbrands, 10-year treasury currently selling for 3.88% as of yesterday, I believe it was. Equity market mature risk premium I have is 5.72%. I end up with a discount rate for Hanesbrands based off of company specific idiosyncratic risk of 18.5% or so. Pretty hefty discount rate, which we'll kind of get into the implications of it when we talk about their actual return a little bit. And their current cash dividend is 8.92%. Very, very hefty cash dividend. Sales 5 years ago, $6.4 billion or so, up to about $6.5 billion. Barely any growth at all, but just a little bit less than 1% of sales growth per year for the last 5 years. Sales capital ratio 1.36. That's $1.36 in sales for each dollar capital invested in the business. For the last 3 years on average for their industry, it's been about $1.62. So the relatively weak in terms of capital efficiency compared to their industry. Returns on invested capital for the last 5 years on average has been 9.63%, and their current debt to equity ratio is just under 180%. I actually didn't check the ratio for their current default risk, but really that's just a backward facing number, so we don't really need to think about that. Don't worry about that, but that was not accurate. Profit margins, they currently have a profit margin of 5.25%, and that compares to their industrial average for the last 8 years of 4.9%. So you can get an idea of what their industry is like over a longer time frame. They currently have profit of $342 million, and they are currently selling for $6.73 per share. The probability distribution that I'm using for my evaluation is somewhat tilted towards the more optimistic fourth model compared to the more pessimistic second model. But as I kind of explained a little bit already, it's definitely not because I'm optimistic on the company. It's just because I'm choosing to lean towards the less pessimistic outcomes a bit more. But really, there's a lot of pessimism across this entire valuation, as you can see here with all the red. But anyway, sales on distribution of anywhere from 4.7 billion in the worst case scenario to possibly 7 billion in the best case scenario. On expected basis, I get 5.8 to 5.9 billion. As I kind of said, kind of a crapshoot number. I didn't really do too much projections on that because it didn't seem worth it. And that ends up being, in worst case scenario, about 6% decline per year, and best case scenario, a little bit under 2% of growth per year. On expected basis, we see sales capital ratio at about $1.25 of sales for each dollar of capital invested in the business. And we see that ending up with returns on invested capital of just under 6%, which is just unsatisfying, especially compared to the previous returns on invested capital, especially compared to their cost of capital, which I don't know if you remember, but when we were talking about their cost of capital, it was like just under 9% or something like that, which shows that they were, the last 5 years, or at least in the last year in particular, they were still earning their cost of capital. But based off of our assumptions, it doesn't look like they're likely to do that in the future. And again, as I described that process when we were talking about the returns on equity. It's like the returns on equity go through the roof when you boost the leverage like crazy, but they start to decrease that return on capital slowly but surely until eventually it's going to start spiraling the other way. And that's what it looks like we're basically on the cups of here. And the share price is already reflecting that. But anyway, debt to equity ratio on expected basis, we see it at about 194%, which is an increase. And I explained my reasoning for my belief in the increase there. Default risk on an expected basis, we see about 3% per year. That's a 3% compounded risk of having to default on their debt because unavailability of capital markets. That's a huge risk, a huge amount of tailwind to their overall value. Profit margins, we have a distribution of 1% to 8%. As I kind of talked about in here, on expected basis, I think I'm being generous to them. But on a worst case basis, you could argue maybe I'm being too pessimistic. Maybe 2 to 3% would be a better thing, because I tend to do a pretty bad worst case scenario in general. But the point is, on an expected basis, I made my case for how you could easily see this going to 4%, and I still have it about 4.8%. So that is what it is. That gets us a profit distribution of anywhere from 47 million in the worst case scenario to possibly 564 million in the best case scenario. On an expected basis, I see 282 million. And that gets us a present value share price after discounting back at the discount rate that we've used across the sets of outcomes of $4.39 per share, which is about 35% lower than the current share price. We have 5-year forward value targets, which is unadjusted for the dividends that they'll pay out. So you'd have to subtract out all the dividends that they pay out during the time frame, which would be substantial. Is $2.62 per share in the worst case scenario to possibly $21.10 per share in the best case scenario. On an expected basis, we see $10.25 per share, which compared to the current share price gets us an expected return of 8.77% per year for the next 5 years. Now you might be looking at this and be like, wow, okay, so you say it's very overvalued on a fair value current present value basis, but you still see them as having an 8 to 9% return. 8 to 9% return is not that bad. I mean, I'm a typical index investor. I'm fine with an 8 to 9% return. That's what you should expect, right? Sure. But the point is that means you're going to get this 8 to 9% return at the expense of all of the volatility that happens in here. Because that's what we're talking about when we see a discount rate of 18.5%. It basically means you would have to earn 18.5% right here just to make up for the risks of the volatility you're going to experience in that time frame. And other people would be like, oh, well, we don't believe in volatility as a measure of risk. And it's like, well, if you remember, most of this didn't come from volatility either. Most of it came from leverage. It came from our measure of leverage. We use volatility as kind of an average of volatility as a basic basis level of the risk, because we think it represents the risks within the company, and we think most of that risk comes from leverage, both operational leverage and financial leverage. We just adjust primarily for the financial leverage, and we use the average of the industry to give us our measure for the operational leverage. So it's like, really, yeah, it's leverage that's the risk. But that's the way in which we proxy that risk in there. So the point is, yeah, there might be 9% returns to be had from Hanesbrands, but man, is that going to be at risks of having really, really terrible earnings on any given year because of that financial leverage you have, because you have such a huge amount of debt, and because that debt has to be paid for in the good years and the bad. So definitely going to be passing on this. It definitely looks like a big value trap to me. Like I said, I was interested in it partially because it had the big dividend, partially because it had the high short ratio, partially because it was such a mature, well penetrated brand. But all of those things are reasons why it's going to have difficulty getting out of the hole it's in. So we're going to definitely have to pass on that one here today. So that's going to do it for our valuation here today. As I've been doing pretty regularly here, I typically put a poll out on the channel in the day following the valuation. So you expect a poll to be released tomorrow, which will have 4 companies that can be voted on for what I'll be doing as the next valuation. The ones that were on the poll that weren't selected most recently was Atcore, Ingalls Markets, and Sally Beauty. I'm not sure what the 4th company I'll be putting on is at some point, but if you have any suggestions for companies you would like to see me value at some point in the near future, you can put that in the comments below. You can put that in the chat. You can also join the Discord, the link to which is in the description below or in the pinned comment in the chat. Join there, and you can also suggest the company there. So go ahead, please give us a like if you're watching live or on the replay. One more time, I'll ask that. Please like the content. It is the best way you can help us grow. Please subscribe to the channel if you're not already. Please go check out that returns video that I released yesterday if you haven't already. All right, I'll catch you all again next time.